Mike. I would say if you think about how domestic political and, really more broadly geopolitical risks have played out in the equity market historically, it is really two simple things. One is there is usually clearly a sharp sell-off, but, we're talking about 6% on average. But the most important point is that it's very temporary. It's very short-lived. The average is 3 weeks down, 3 weeks back up.
And you're saying if something were to worsen from here, we're not there yet. We didn't get a 6% sell-off on this.
No, because I would argue yesterday's political news, and that is not my forte, is a marginal incremental negative. But the simple point I'm trying to make is, a sharp but short-lived sell-offs. Yeah. And then, the equity market has always basically gone back to what the economy and earnings are basically
which you're not thrilled with the way that's going. But let me just
currently no. Yes.
Yeah, let me just get Mike on the. Woke up yesterday morning, after thinking about it the night before, and I checked PredictIt, and it's very thin right now. There's not a lot of money being bet. But yesterday morning, I sort of thought if there was a true constitutional crisis, we wouldn't have been up 120 points.
Right.
By the end of the day, we were down not that much, 0.5%.
Yeah, about 0.5%.
About 0.5%. The predicted numbers are finishing the term is still 90%.
That's the point.
The impeachment is it went to 57. I think it's back below 50.
Yeah.
At this point.
What's interesting is the market did pick up a little bit from the lows when the president said he would release the transcript of the call. So there was a little bit of sensitivity to trying to figure out how this plays out. I mean, honestly, this isn't, I don't think, one of the top three swing factors for how the market's going to.
Not even the top three?
No, I really don't. Well, the top three are probably all the same. Which
have you seen the newspaper? Have you seen the newspapers today?
But what exactly should the market be pricing in?
Right.
So here's the distinction between the Nixon experience and Clinton. They were both in a second term.
Yes.
So I think it's a little early for the market on a day-to-day basis to be handicapping the outcome of the 2020 election based on what's going on right now, because as you say, the odds for President Trump finishing his term and PredictIt is still 90%.
Yeah, but the issue that this wraps up the top two candidates, the Republican and the Democratic candidate in this, and that's just
people think Warren's already ahead.
That's
you think?
But so but then what? So what should the market be pricing about that? Should the market be saying it's going to bum out the public?
I guess we don't know.
It's already bummed out, right?
Right?
The consumer confidence yesterday showed this huge plunge in 55 and over, or people 55 and over in consumer confidence. They're the ones absorbing cable news all day.
They showed Giuliani, the latest poll showing Warren ahead, and he just went, "Oh!" No, kidding. That did not happen. But hey, so what?
Nothing. Nothing.
Binky, why, in your view, God, I was working so hard on Biden. Why, in your view, Binky, is the market 15% overvalued?
Because growth has slowed. I would argue the slowdown in the U.S. is, pretty broad-based. It's been going on for a year and a half, depending on how you measure it. And equities, are essentially where they were at the beginning of January in 2018. So you have a market that's kind of flat. Sure, it took some spills in the middle. And if you look at what's been happening to macro growth, it sort of slowed.
You say we're at stall. We're close to stall speed in the economy.
Many people would argue that the signals are pretty mixed. What I would point out is that if you look at the number one indicator of where the U.S. is at, it's the labor market. And if you look at private payrolls growth, and with full technical explanation, I'm taking the 6-month change, and I'm using an annual rate because labor market data tends to be a bit noisy. As of the last print, we are running at about a 1.3% annual rate. That is the slowest in this cycle. For those that say that, well, services are okay. Services are much bigger than manufacturing, and you wouldn't be at the lowest point in the cycle if a big chunk of the slowdown in the labor market hadn't come from services. In terms of, is 1% growth, a big deal? I think the point to keep in mind is that every time private payrolls growth has gone below 1%, we've basically ended up in recession. So 1.3% is, in my view, of course, it's a lot below 2.5% in the middle of last year, but it is dangerously close to stall.